Malaysia's Budget 2016 may not be the best platform to instill investor confidence in the ringgit. Independent forex strategist Dr Suresh Ramanathan said that the falling ringgit is not about the country's fundamentals or sentiments. He also said that the ringgit is not facing a long-term decline, but rather facing a broad-based pressure on many fronts.
I think the key thing to take into account is that we've seen monetary policy not moving at all in the last few months, and we've seen external headwinds coming off. We also have internal headwinds. But the key here is that I'm looking at is that the fiscal policy will be marginally expansionary to compensate this headwind itself. The ringgit has got very sentiment driven. You have the external sentiment of interest rate expectations being raised in the US, monetary policy being normalized, and then you also have the slowing Chinese economic growth. At the same time, we have this capital outflows out of emerging Asia. That's something which is difficult to be comprehend and difficult to be managed. But on the internal side, what we notice is that domestic demand is slowing down. That's one thing. We also have actually the fact that the key being that there's liquidity issues on the ringgit itself. When I say liquidity here is actually the buying price and the selling price in the trading floor for ringgit. The spreads are very wide. I think that is where something which we could actually address to reduce the pressure on the currency itself, which means it's more of a liquidity issue rather than actually trying to leave it all just to markets, global markets to drive the ringgit itself. So I'm proposing that actually that the budget at least should address the liquidity issues in collaboration with the central bank itself to reduce the pressure on the ringgit. So what I'm proposing is that introduction of liquidity into the system, be it ringgit or dollar. The other mechanism which I'm actually proposing is the dual currency investment or the dual currency deposits. We've got close to around like 450 to 500,000 Malaysians working in Singapore, and we've got a good network of Malaysian banks in Singapore as well. So what I'm proposing is that would it be fine that Malaysian banks offering higher interest rates on deposits in Singapore, catering only non-resident Singaporeans, that means actually non-resident Malaysians itself, that they will be able to put this money in Singapore, in Malaysian banks, and able to withdraw the money back in KL. So it's actually working out very well because Malaysia needs the liquidity, at the same time needs the foreign currency itself. At the same time, investors, Malaysians who are working in Singapore, will be getting higher interest rates, provided they withdraw the money actually in Malaysia itself. So it's a mechanism which I think it's viable, and the banks that actually provide this type of tools should be exempted from statutory liquidity requirements itself. So for a short time period, which I've seen actually countries like India proposing it 3 years ago. It worked very well when they had a current account balance problem. I think Malaysia could also follow suit in that way because we need liquidity eventually. So that is one market mechanism I'm looking at. The other market mechanism is direct injection of ringgit liquidity into the system through a cut in policy rates, or actually having bilateral currency swap agreements to provide dollars into the system itself. We can cut interest rates, we can reduce the reserve requirements, statutory reserve requirements. I mean, we can also actually provide the dual currency deposits for offshore Malaysians. We can also actually have bilateral currency swap agreements to provide dollars. So there are a lot of market mechanisms there. So I find it very strange that actually none of these measures are being introduced at all. Yeah. And the other thing that you can directly reduce is, address the issue is actually you can compress the buying price and the selling price in the interbank market. If you look at countries around the region itself, we've seen the Indonesian rupiah weakening, we've seen the Indian rupee weakening, we've seen some of the Chinese yuan also weakening, but there's policy measures that are being in place. Indonesia came out with rules pertaining to arresting the decline in rupiah. They gave out a lot more transparency on what they're trying to do. But in the case of Malaysia, the ringgit is actually, it's being left to the whims and fancies of market itself. So the volatility is extremely large. So you need some sort of market mechanism to solve this. How good is it? How effective it is? It is very important that you provide the right signal to the market. If you provide the right signal to the market, then it's able to adapt and see that there's a hands-on approach by authorities on trying to curb the ringgit from weakening. I mean, I can't imagine ringgit weakening beyond 5. It destabilizes the whole economy. If the measures being mentioned, if it's implemented by this year or in the next few weeks, I could safely say ringgit can go as low as 3 ringgit 70 cents. If there's no introduction of these measures and no market mechanism, it is very likely that ringgit remains around the 425 to 450 range. So that is why it's very pertinent that we provide that liquidity, because if we provide the liquidity, we can bring the ringgit back towards where it's going to be. It shouldn't be trading at these levels at all, because it's actually purely a liquidity issue. It's nothing to do with fundamentals or sentiment at all.
According to Dr. Suresh, to stem the decline of the ringgit is to ensure a more knowledge-based and digital economy. Should more active market mechanisms be implemented to arrest the declining ringgit? That is the $64 question that will be asked on the budget day. Zunaira Saieed, Star TV.